This is an example of calculating net present value, and we are going to look at an example where we're going to look at whether it makes sense for this person to invest in opening their own practice. So from Moodle, I would suggest that you print out the Word document for Mary's ophthalmology practice, and I will quickly review what the details are. So Mary's uncle passed away, left her $500,000, and she decided she wanted to open her own ophthalmology practice. She would use all the money, the $500,000, and she determined from a business plan that she could generate revenues of $700,000 a year, and she's doing this projection for the next 3 years. She developed a budget, and her operating expenses would be $400,000 per year for each of the 3 years, but that did not include depreciation. She would need to purchase equipment and renovate a building that she would rent, and that ended up to being $200,000. At the end of the 3 years, she would sell most of the equipment and get new, and so she would give a salvage value of $50,000. And so at the end of the 3 years, she would have spent $150,000 net of the equipment. And if you think back to your counting days for depreciation, that would be $50,000 a year. The other important aspect is how much is the value or the cost of interest during this time period, and so from her banker she learned that it's 4%. And so what we want to do is figure out, does this make sense? So in Excel, I created this shell, and we will populate the various important pieces of information. So the first is, what is the initial investment? And so we enter this as a negative. So she's going to invest $500,000, $500,000. Okay, this is in year 1, or year 0 rather, in the beginning. So in year 1, 2, and 3, she said that she would earn revenues of $700,000. Okay, so we populate that. Now we have to subtract the expenses, right? So her expenses are $400,000 each year. And we know from what we summarized before, the depreciation, right? She spent $200,000 on the building renovations, and then it has a salvage value of $50,000, and so it's $150,000 divided by 3 years. Now for this purpose, we are not going to follow the mid-year convention, where we would only really in the first year record half of that amount. For this purpose, we're going to record the full amount of depreciation each year, and so that is $50,000 for each of these years. So her operating income is $250,000 for each year for the first 3 years. However, as you may recall, depreciation is a non-cash expense, right? So when we book depreciation, we debit depreciation expense and we credit accumulated depreciation, but there is no cash involved. And so if we're looking to see what is the net present value of her $500,000 investment, we need to add back that depreciation. So we're going to add back $50,000. So her net operating cash flow for year 1 is $300,000. For year 2 is $300,000. And in year 3, we add back the $50,000 depreciation as well. But also remember that she is going to sell the equipment for $50,000, so she's going to receive another $50,000. And so her projected cash flow in year 3 is $350, in year 2 is $300, and in year 1 is $300. So we know that the cost of capital, the interest rate, is from the problem 4%, right? So we're going to, and that's for each of the 3 years. So now how do we calculate the annual or the net present value? Well, there's three different ways we can do it. We can manually calculate it, and your book shows you how to do that. I don't think many people would manually calculate that today, but they could. They could look at in your book for the table, or you can do it in Excel. So Excel is the best way to do that, and the way most people would do it today. But we're going to do it both with the book and the table as well as in Excel to see if we get the same answer. That's a good way to double check yourself. So if you go to page 296 and you look at the column 4%, we're going to record there the numbers for each period. So in period 1, we would have 9615. Period 2, we would have 0.9246, and in period 3, 0.8890. Okay, now think about why would those numbers go down? Well, there's the time value of money, right? So the more we have money that we can invest, the more we can earn. And so it is $1 today, and we can invest is worth more than if we got that dollar in a couple years. So we just do for the 300,000 times that factor, and we can calculate each year what the net present value is of that year's activity. So now we add these 3 years together, and we get $876,980. However, we invested $500,000, and so our actual present value of cash flows is $876 less the $500,000 is $376,980. So by our investing $500,000 in year 0, we would have earned $377,000. So let's double check that number by doing this in Excel. So the way we do that in Excel is we go to Formulas, and this is a financial calculation. So we go to Financial, and we scroll down to Net Present Value. So we know our interest rate, right, is 4%, and you need to put in the percent or it won't calculate it correctly. And we know that in year 1, our net cash that we receive, our cash flow is $300,000. In year 2 is $300,000. And in year 3 is $350,000. Now, if you had multiple years, you would just keep entering in the years, and you would scroll down over here in order to be able to do that. You can see it goes up to 102 right here on this screen. But we're all set. So we did the 3 years, 4%, and let's hit OK. So we get the answer here of $876,977. So I would say 876,977 and 876,980 is pretty close. So here we have some rounding, just a rounding error. So again, 876,977, and we would subtract the $500,000. And so for here, we would show a positive cash flow or positive net present value of $377,000. So would we want to do that, or would Mary want to open her own practice? I would say yes, that would be a positive thing to do.